Ladies and gentlemen, thank you for standing by. Welcome to the WHV International Equity Strategy Fourth Quarter 2013 Review and Outlook webinar. During the presentation, all participants will be in a listen-only mode. If you need to reach an operator at any time, please press *0. As a reminder, this conference is being recorded Wednesday, February 5th, 2014. I would now like to turn the conference over to Brian Forth, Director, Relationship Management. Please go ahead.
Good afternoon, everyone, and thank you for joining us today to review the recent quarter and year for the WHV International Equity Strategy with Dick Hirayama. Mr. Hirayama created the international strategy and has been the lead portfolio manager since its inception back in 1995. He has been in the financial industry for over 44 years and with WHV since 1990. For give or take the next 60 minutes, we will start to review the strategy's investment thesis and process and follow the discussion of our favorite supercycle sectors, as well as the portfolio positioning and outlook for the current year. After this, we'll hold a question and answer session. Please note that questions will only be taken through the web browser. If you look to the bottom left corner of the browser right now, you'll see a Q&A box. You can hit submit there at any time. Good afternoon, Dick, and thank you for joining us today.
Thank you, Brian. Welcome to the year-end conference call for WHV International Equity Strategy. If you have the slides, on slide 3, the strategy overview for the product. I won't go into reading every single bullet point, but our basic strategy is that we are a global macro top-down manager, meaning that we view the world first to see what the big picture is. You can say that we're in a satellite 1,000 miles above Earth, looking down at the Earth to see how the world is spinning. Is it spinning fast? Is it spinning slow? Is it spinning to the left? Is it spinning to the right? And then once we determine that, then we take the space shuttle back down to Earth and then land in the areas that we think are growing the fastest. On slide 4 is our strategy, positioning, and conviction. We have believed that global capitalism has ruled the world, especially since 2000. Some call it globalization. And global capitalism works in a certain way every second of the day. It is trying to increase profits through increased sales and reducing costs. But the latter path of capitalism, reducing costs, have been the most dominant over the past 14 years for corporations trying to increase profit margins by reducing costs, and therefore with the whole world waving the capitalistic flag, the lowest cost centers of the world would benefit from this supercycle trend, and the lower cost centers are the emerging market countries or the developing countries such as Brazil, Russia, India, China, Indonesia, Latin America, etc. And this has been going on since 2000. Now, the emerging markets are important because currently they're growing at about twice the rate of the advanced economies, but their profile of growth is totally different from ours. We in the U.S., Europe, and Japan, the advanced economies are service-oriented. That's why we're on this conference call today. We're in a financial services business, and the countries also have grown through governmental services and healthcare services. The emerging market countries are too poor to grow through service because they have too many people, 6 billion of the 7 billion on the planet. So their profile of growth is totally different. Although they are growing much faster than we are, they are engaged in industrialization, something that we accomplished initially during the 1800s and 1900s. We launched, and as well as the Europeans launched, the first great industrialization phase starting from the Rockefeller, Carnegie, Mellon, Vanderbilt days through the 20th century, and now the more populated emerging market countries have launched the second great industrialization. So this is truly a major supercycle that has lasted since 2014 years, but can have the potential to grow for many years to come. As far as our sector allocation, we have felt for the past 14 years that the prime beneficiaries by sectors would be the energy, materials, and industrial sectors, because the emerging markets are industrializing, and therefore they are consuming a significant amount of natural resources, energy, iron ore, steel, etc., and placing investments in these areas, we have felt for the past 14 years would add value. As far as our direct emerging market exposure, we actually have a very low exposure of only 4% because we are not an emerging market manager. Our approach, we feel, is an indirect way of exploiting the superior growth of the emerging markets, sort of through the back door. The emerging markets have tremendous strengths. They have obviously low-cost wages. They have tremendous amount of capital because they are net savers. They have capital inflows because they're export-oriented. They accumulate our foreign exchange reserves. They have low-cost land. But the one serious weakness that they have is that because they are industrializing, they are short of energy, materials, industrials. So China and other emerging market countries have to import a huge amount of oil to fuel their growth, iron ore to produce the steel to manufacture the cars, copper for construction, for commercial buildings, residential buildings, cities, transmission grids, the copper to transmit electricity, etc. So we have felt that this is a long-term supercycle trend, and we feel that it should continue for the foreseeable future. Page 5, as I previously mentioned, the emerging market countries are truly engaged in something really big, a second-grade industrialization, of which 6 billion people could be involved. So we in the advanced economies dominate the world, only have 1 billion of the 7 billion, so this is truly a really major trend. China is definitely the growth leader among the emerging market countries. In fact, China is the growth leader of the world. They grew 7.7% last year, and skeptics have believed that China's growth is going to slow, but considering the fact that all the advanced economies, ourselves, the Europeans, and the Japanese, could barely grow 2% last year or less, and they're projected to grow about that amount a little bit faster this year, and China is forecasted to grow 7%. So we feel that China truly is the growth engine of the world and has the potential to grow for the foreseeable future. And because they are the leader in the industrialization of the emerging markets, they are key as far as the demand supply for the natural resources of which our companies are involved in. And we feel that China's industrialization feeds into their urbanization trend as countries grow through urbanization, as poor farmers who are highly unproductive, young adults on the family farms move to the cities, and they become highly productive in construction, assembly line work, etc. And also the quality of education in the big cities is many times better than the school system on the farms. So this is how poor countries grow, is through urbanization, through higher productivity, higher quality education, higher incomes, higher spending, higher growth. And the Chinese federal government has tremendous financial capabilities, dry powder, to offset any shortfalls in economic growth due to shortfalls in export revenues, etc. Page 6 is a graph of the urbanization of China relative to the U.S., Japan, Korea, and Germany, and you can see that In the beginning, we were all once farmers, including ourselves in the 1700s, and we all become 80% urban. And when we become highly industrialized or advanced, China is up from 20% urbanization in 1978 when they adopted the market-based model. They're currently about 54%. And the UN expects a 1% increase in the urbanization rate to 2020, and that continues and sustains their growth for the rest of the decade if they manage to hit that target. Slide 7, you can see that we in the United States, we are a car culture. We have 7 cars for every 10 people. China only has 1 car for every 10 people, but they also have 1 car for every 10, one light truck or commercial truck for every 10 as well. So that although they have 120 million cars, they also have about an equal number of trucks. So they have a lot of vehicles on the roads, but their roads, expressways, highways are newly constructed. And so they have a new network of highways that young Chinese can drive from Shanghai to Beijing, et cetera, to see relatives, et cetera. And you could say that the Chinese car culture, which is relatively in its infancy, is similar to where we were in the early 1920s. So we in the United States invented the Model T Ford in 1908, and by 1929, in 2 decades, there are quite a few cars in American garages before the Great Depression. And similarly, you could say Chinese car culture is still off the starting block, but nowhere near a peak, and they could be where we were in, say, 1921, 1922, with another 5 or 6 or 7 more years of increased car ownership. And they have the potential to double or triple the number of cars that they have. And in fact, although it's a very small percentage of the Chinese car market, it's interesting that when a Chinese adult buys a second, trades in his first car for the second car is larger than the first car. And the fastest growing segment of the Chinese car market, albeit very small, is their SUV market. So they tend to follow our trend, bigger and bigger cars. And now that they can have more than 1 child, that means that they may need a bigger vehicle. And so there's a lot of potential for car demand, which means steel demand to construct them, gasoline demand, oil demand, and so there's quite a potential for oil demand going out into the future. Page 8, in the Wall Street Journal and other financial magazines and newspapers, it's highlighted that China's debt levels have increased dramatically over the past 5 years, and that is true that their overall debt levels have increased dramatically over the past 5 years through what is called the shadow banking system, where the local governments want to beautify their city in order to attract Western companies to come in and build a plant. So they upgrade their towns and cities and they beautify them and update the infrastructure, the roads, the highways, the metropolitan systems, transit systems, etc. But since they have no property tax system, they either have to expropriate land from poor farmers, or they take out debt in order to finance these upgrades, and therefore, because the local governments do not generally, they also borrow from smaller banks, then the debt levels have expanded dramatically, as you can see on page 8. However, if we look at the federal government, the federal government has more foreign exchange reserves than any other country. In fact, practically all the countries combined. You can see on slide 8 that they have now $3.8 trillion of foreign exchange reserves. So they have a huge amount of financial firepower that could offset an economic or financial crisis. In addition, they have one of the strongest currencies in the world. The other BRIC emerging market countries, Brazil, Russia, India. If we take India, since the peak of the previous economic cycle in 2007, the Indian rupee currency has declined on average 6% a year since the end of 2007, whereas the Chinese currency has advanced 3% a year since the end of 2007. So China is truly unique among the emerging market countries. They have, the federal government at least has very powerful balance sheet. They also own a lot of companies, PetroChina, etc. So most of the big corporations and banks in China are state-owned or state-run. So one analyst, Chinese analyst, has estimated that the worth of the federal government is something similar to about $11 trillion. And it's kind of interesting, you had read on the front page of the Wall Street Journal today that because Portugal has so much debt and they're trying to reduce the debt, they're trying to sell some of their national artwork, and they're getting complaints from citizens saying that that's a national treasure and we don't want to sell our national treasure to knock down the national debt. But here China has the huge financial treasure bank, so to speak, in order to put out fires that might pop up here and there. Page 9 is our sector structure. Since 2000, we have overweighted energy because we have felt that the emerging market countries are short of energy, whether it's China or India. They have to import oil in order to fuel their industrialization. And also eventually, when they become a car culture, then they will need more and more oil to produce either gasoline or diesel fuel. And also in the case of not only energy but natural resources, those are by definition limited. As a resources, God only created so much in the ground, and we consume it every year, and it's not going to be replaced. And so that's what it was called depletion. In the case of oil, it's about 6% per year. So it's very difficult to find a significant amount of new oil in the ground. In fact, if you read the recent quarterly reports of Chevron and Exxon, two of the largest integrated oil and gas companies in the world, their production actually declined last year because they couldn't find enough new oil to replace what they had been producing. In our case, for instance, we own Suncor, which is a Canadian oil and gas producer, but they're big in Canada producing synthetic oil from the oil sands, and they have 3 decades of resources to produce synthetic or oil, and so they don't have the risk of having their properties expropriated or drilling a dry hole. They know where it is. It's just a matter of digging it up. In case of materials and natural resources, Rio Tinto as well as BHP are big Australian producers of iron ore that goes into making Chinese steel or copper, etc. And so we feel that those companies in the natural resource space will benefit from the continued industrialization of the world. And in the case of industrials, Canadian Pacific Railway, we own actually both Canadian railways, and we have felt for the past decade that the Canadian railways would benefit because Canada is rich in energy and natural resources, and so The rail companies would benefit from transporting Canadian energy, metals and mining, metallurgical coal, fertilizers, potash, wheat, to corn to the Pacific Coast to export to Asia, or sometimes to the West Coast to Asia, or sometimes to the East Coast to Europe. So we have felt that the Canadian rail companies will be good investments going forward as well. Page 10, just looking simplistically at our relative performance to the benchmark. Our performance relative to the benchmark was substandard in 2013 and also 2012 and 2011 because being economically sensitive for our energy materials industrial commitments, when global growth is decelerating, meaning that if the growth rate slips from, say, 2011, 3.9 to 3.2 in 2012 to 2.9 in 2013, the market tends to focus on away from economically sensitive investments and towards what is called early cycle investments, and that has been the focus of the market for the past several years as the global economy seems to have lost momentum. But forecast going forward for this year, next year, is that global growth will again pick up, led by the United States and Europe. And if truly those forecasts come true, then historically investors gravitate towards economically sensitive investments such as our energy materials industrials commitments. Page 11. The global outlook, I'll mention something probably that for those who are loyal investors and followers of our product, something new and illuminating that I haven't mentioned before, and it's based on the current environment or how the stock markets have acted this year. First bullet point on page 11 is what I mentioned earlier, that if truly global GDP growth accelerates this year, then traditionally investors then focus more on economically sensitive investments. However, reading today's front page of the Wall Street Journal, there are issues or questions about is global GDP growth slowing down again? And so my reaction to the front page of the Wall Street Journal today is that if that occurs, then I believe that, again, similar to 2009 when we were in the depths of the Great Recession, that global policymakers, especially those of the advanced economies, will act rationally and stimulate. And that is what saved the world in 2009, 2010, is that all the policymakers of the world, whether they were in the American, European, Japanese, Chinese, Indian, Brazilian, Russian, they all acted rationally and stimulated, both fiscally and monetarily. And this time around, if global GDP growth decelerates and unemployment rises, at least in the advanced economies, I would expect that the central banks of the U.S., the UK, the Eurozone, and Japan would stimulate to avoid a slowdown in their respective economies and higher unemployment. Now, I also mentioned in my, if you read my year-end letter, that inflation actually is a good word nowadays. One would not think so. Declining inflation has been actually one of the biggest positives for the world since 1981, when the inflation rate, at least in the United States, has fallen from 15% down to under 2%. And that has reduced interest rates, and global growth has been exponential really since 1981 because of disinflation and sharply declining interest rates. But now the inflation rate is possibly too low, and in certain regions such as the Eurozone and Japan, it's testing the zero line or deflation, which is something that the advanced economies, the central banks of the advanced economies want to avoid. So there may be a new mantra among the central banks of the United States, the UK, the Eurozone, and Japan, that a little higher inflation is better than low inflation where we are currently at about 1.5%, and something more like 2 or 2.5% is more optimal. And the reason is that if you have a little higher inflation, consumers buy earlier and they buy more goods and services because those products and services or goods and services are going to be higher next year, so let's buy it this year, whether it's a consumer staples product or a consumer durables product like a refrigerator, freezer, or car. Same thing for businesses. If they see that their raw materials are going to be 3% higher next year, then let's buy it this year. So this part is due to earlier consumption, and part of it is due to inventory accumulation. But the bottom line, even in both cases, is that spending increases in magnitude, and spending occurs earlier, and that stimulates economic growth and it stimulates employment. So, and I believe that is the thoughts of the new chairperson of the U.S. Federal Reserve Bank, Janet Yellen. She believes that raising inflation a little bit can have a big impact on reducing unemployment. So if indeed that is her philosophy, that she can convince the Federal Open Market Committee, then we could have more inflation here and potentially in Japan and the Eurozone and the UK. And if so, then potentially investors will consider hedging against purchasing power degradation and paper money devaluation, because the way to get the inflation up is to print more paper money. And so if that's the case, historically, when inflation starts to tick up, global investors start to think about reducing their paper money investments and shifting towards real or tangible assets, of which the largest classes are equities and real estate, but also energy, natural resources, precious metals, etc. And the third and last bullet point is that if China's growth rate falls below a certain floor that the government has set, potentially similar to the Bernanke put of the last 3 years, where if our growth or unemployment were suboptimal, then the Federal Reserve Bank would continue with aggressive monetary policies, and indeed Mr. Bernanke engaged in 3 quantitative easing programs. And I think that China has the potential for a similar type of reaction to a weakening economy. Mr. Li is the premier of China, number 2 or vice president, and he believes in urbanization of China in order to increase its growth rate and employment. And so I think if China's growth rate unexpectedly falls short, then he and his president, ZXI, have the potential to prevent a hard landing by spending some of their $3.8 trillion. Now, just comparing China's condition to ours, we and Japan and the UK have to print money or create electronic credit in order to stimulate monetarily. China doesn't have to print money because they have the $3.8 trillion in the bank, so to speak, that can support their economy without having to resort to degrading their paper money. Now, I would conclude, and this is something new that I haven't mentioned earlier, but I think it will be illuminating or stimulating, maybe revealing is the current condition of the market, since, as you all know, the S&P is down and the MSCI, EFI, or the international markets are down. Japan is down, as we read in the Wall Street Journal. And I think it's because of what I would my definition of the new normal. The new normal is that here we are 5 years off the bottom from 2009, and economic growth is suboptimal. Unemployment is above average. If you look at the Eurozone, it's 12%, a staggering number. And if you look at the unemployment rate of the United States, 6.7%. But if you adjust for the people who have left the workforce because they have become frustrated or disillusioned about finding a job, if you add back in just half of those who have left the workforce into the unemployment numbers, then the adjusted unemployment rate in the United States is 2% higher, or 8.7%. And I think that Janet Yellen believes that the unemployment rate is more like 8.7 rather than 6.7, and I believe that she, if that is her belief, then she would most likely continue with aggressive monetary policy, which would include quantitative easing and monetary printing. Now, why are we in secular stagnation? The reasons are that up until 2007, the world's growth was self-sustainable because consumers, businesses, and the government were able to engage in what they've been doing since post-World War II, borrowing and spending. But since the Great Recession, no longer can consumers borrow and spend. They have become more conservative, they're more budget conscious, and also they can't get a loan from the banks because the banks are now too conservative to give out loans, and you have to put down 20 or 30% in order to buy a house. And governments now are fiscally austere. We have raised taxes in the United States. The Japanese are instituting a consumption tax this year. The Germans of the Eurozone want all the weak countries like Portugal, Italy, Spain, Greece, Cyprus to increase taxes and reduce their spending. So in advanced economies, you have fiscal austerity, so the governments are now going in the reverse direction as far as stimulus. And in the case of businesses can actually spend, but they have become frightened by the Great Recession, and now they're very conservative in their capital spending, and therefore, because they are not spending as much for future long-term growth, they are under hiring permanent employees and hiring maybe quite a few temporary employees. So that's another problem on the employment front. So what this means is that governments, consumers, and businesses can no longer borrow and spend, and so growth, therefore, is suboptimal or secular stagnation, and something new since post-Great Recession, and this is not going to change. The problem is that because of this new state of affairs, and this is my view from the satellite 1,000 miles above the planet, the world needs stimulation. The world will not grow on its own because of these structural problems, and the only way now to stimulate is through aggressive monetary policies, quantitative easing, electronic credit creation, money printing. And this is the only way you can sustain growth now in the new normal. According to my definition, we are liquidity driven, and once you stop or reduce your liquidity generation or credit generation, the economy, the stock market slows down, and the economy slows down, and unemployment rises. So I hate to use this term, but now we're stuck with monetary heroin. We need the money printing in order for the stock markets to continue to perform, and therefore the economy to perform, because the economy is always looking at the stock markets, and it can impact consumer confidence and business confidence. So bottom line is that I think that if the growth rate of the various countries and regions in the world start to slow down and then unemployment rises, then the central bankers of the United States, the Eurozone, the UK, Japan will start to jack up their money printing. And if you look at the performance of the stock market just over the past couple months, the S&P 500 is down 5% this year. Why? Because we started to reduce our bond buying program from $85 billion a month to 75 to 65, and so the markets project that it's going to be 55, 45, 35, 25, 15, 50, and so the stock market goes down because this is a liquidity-driven stock market. It's a liquidity-driven world. Also, in Japan, the Japanese stock market is down more than the S&P 500. Why? Because the Bank of Japan increased their balance sheet by buying a lot of assets, printing a lot of yen, and now they have started to slow down. And what happened? The Nikkei average is down over 10%. So this is the brave new world, the new normal, and on that long-winded presentation, I'll open up to questions and answers.
Thanks, Dick. I appreciate you taking the time. Thought that was a great review of the overall investment thesis as well as the way the portfolio is currently positioning. I guess in summary, I'd like just to focus on a couple key points, I think important takeaways. One, that we feel that the demand for natural resources going forward should remain robust, with an emphasis on the urbanization and industrialization trends among the emerging markets, in particular China, with a focus on the continued urbanization of the population, looking to grow about 10% over the course of the next decade, equating to approximately 17 million new people moving from the countryside into the cities. Second, you made mention towards the very end there of the fact that both the IMF and World Bank are forecasting for global GDP to begin reaccelerating. And historically, our investments in more economically sensitive areas have tended to benefit in this sort of environment. And lastly, towards the beginning, you hit on the fact that in spite of the talk about China slowing down, they're still the second largest economy in the world, growing in excess of 7%, which is pretty spectacular for an economy of that size. I think it's safe to say that looking ahead, we feel that these scenarios do provide compelling support for the portfolio in our allocations into the energy, materials, and industrial sectors. I think at this time we have about 15 or so minutes left. We'd like to address some questions that did come on in. Looking through the list here, we hit briefly on performance over the last couple of years. I was wondering if you could just provide a few key bullet points on the underperformance of last year and what drove that, maybe highlighting the impact particularly on the energy and materials areas.
Oh, thank you, Brian. Yes, it's a very good question. The material sector performed poorly last year because industrial production growth in the world was slowing down, and so our natural resource companies underperformed the market. We feel that going forward, the world has to industrialize in order to grow, especially the developing countries, and there should be continued demand for natural resources. Rio Tinto, BHP, Vale, they have several decades of or more of the natural resources that they produce. In the case of energy, as I mentioned, for instance, Suncor has many decades of future synthetic oil or heavy oil production. So we are structured for the long term, and this is what I call long-tailed secular growth trend or supercycle trend. And so we have been in it for 14 years, and we feel that the trend should continue for the foreseeable future.
Thank you. In that same vein, looking at this long-term view that you have, has been in quite some time now for 14 years. In light of recent performance, is there anything that you're seeing or have seen that will make a change to your overall supercycle thesis?
Well, Brian, I feel that leaders of countries will act rationally for two reasons. Number one, for the benefit of their citizens, and number two, to stay in power. So this occurred during 2009, 2010, 2011, when one research firm computed that there were over 800 individual policy stimulus moves by countries around the world because everyone was adopting the capitalistic model, and they were stimulating to prevent the unemployment rate from skyrocketing, and also to prevent themselves from being either voted out of power or kicked out of power. And you can see that when things go wrong in countries as far as unemployment or unrest, you can have leaders that have been in power for 3 decades thrown out in a month. Tunisia, Egypt, Mubarak, Libya, Gaddafi. 3 decades, they were dictators, they had the military on their side, and they were all removed within a very short period of time. And you can see what's happening in Kiev and the Ukraine. And this occurred also in the former Soviet Union in 91, and the Berlin Wall knocked down in 89. Actually, in this new world, people have power. Power to the people, and it's because if the people become disillusioned, dissatisfied, and they become unemployed, they can group together, demonstrate, riot, and initiate a revolution. And this is the case with China. And if the Chinese economy creates too much unemployment, they're going to have a potential revolution. And the former premier of China, Premier Wen, who left power early last year after 10 years in power, he stated publicly that if China doesn't continue with its social and economic reforms, a second cultural revolution is a potential possibility. And in revolutions, the former leadership gets kicked out, imprisoned, or shot. And so that can happen in China, it can happen in Russia, or any other emerging market country. So I think that I'm assuming that leaders act rationally, either because they truly do have the citizens of their country in mind, or because of their own power or finances. And so I think that if growth falls short in various countries, policymakers will stimulate in order to stay in power and or get reelected.
That's great. Thank you. The number of questions on emerging markets clearly, but also the last points that you made about structural stagflation. I know you made mention that there's a lot of potential for further quantitative easing and further stimulus, and clearly that could lead to the potential for inflation around the world. And I was wondering if you could expand upon your thoughts on how important inflation is to the portfolio and the overall investment thesis.
I think at this stage of the global expansion, Brian, inflation is very important because in this state of suboptimal growth, large output gap, despite the fact that interest rates are so low, at least the short-term interest rates are so low, that we need continued stimulation, and if the only tool is money printing, quantitative easing, electronic credit creation, that eventually inflation is a monetary phenomenon, and you print enough money, you're going to push up the inflation rate, and a little higher inflation has its benefits as long as it's moderate. But once it goes beyond a certain level, and economists can debate about what that level is, it could be 5% or something, nothing like the where we were during the late 70s when it was double digit. I think that higher inflation, and some economists believe that 6% inflation would be good for the United States at least. Certainly it's not good for the emerging market countries. For instance, India has an 8 or 9% inflation rate, and Brazil, Russia have a high single digit or 5, 6, 7% inflation rate. And so for them, they are fighting inflation, and for them, that's a problem. But in the case of China, they have attacked inflation since 2010, and their current inflation rate is 2.5%, so they have the potential to stimulate without impacting their inflation rate to a level that might become dangerous.
That's great. There have been some additional questions that we've seen filter in over the course of the discussion here that are a little more short-term oriented over the coming year. And it's kind of curious, especially with the rough start to 2014, the emerging markets in particular. What are your near-term views on the environment and how that would shape up for the portfolio?
Well, I tried to touch on that earlier, Brian, as far as why the stock markets have been down this year, and I believe it's because the equity markets are liquidity driven, and once you slow down the generation of liquidity or the potential credit creation, then the stock market starts to lose steam, and then the economy starts to lose steam, and then the unemployment numbers start to deteriorate. So I think that when that filters through to the economy and to employment, and then the employment numbers start to deteriorate, then policymakers will start to rethink and then become more stimulative. And I think policymakers are looking at economic data every day and every week, and as employment numbers deteriorate because consumer confidence and business confidence start to deteriorate due to a lower stock market, that policymakers will have to respond with more easing in order to prevent a slowdown in their respective economies.
Great, thank you. It looks like we're pushing up on that hour mark and running out of time. I want to thank you for everything today. For those on the call, I want you to make note that you can download a copy of the presentation as well as Dick's most recent portfolio manager letter and other materials by clicking on the green folder at the bottom of the screen in front of you. I want to thank all of you for taking time to listen today, and look forward to speaking with everyone in the future.
Thank you very much for your time.